So this is Martin from Secret, the channel for learning about trading and investing. First of all, wish you all a very happy New Year 2025. And there was 2 weeks where there was no analysis, and apologies for that since I was traveling. Let's have a new year and new trade plans, and let it all be successful to all of you. Let's get started. So here we have the bird's eye view, the weekly views on the both indices, left side Nifty, right side also Nifty, but it's a bird's eye view on the daily time frames, and Banknifty is there on the next slide. So here we see that there's a trend line that's almost kind of a parallel channel, and retracement was happening. A recovery attempt did occur, but it failed, and market is facing some kind of resistance over that zone, and that's what you see. On the long time frames on daily, you see that it was a very volatile week, but we have a parallel channel, and Nifty is moving within that, and any breakout or breakdown would be decisive, right? Similarly, in the weekly candles of the Banknifty, right? Weekly charts are showing that there has been an ascending wedge, which is narrowing and narrowing, and still it seems like market is playing in that very narrow ascending wedge. Right? Any breakdown from there or breakout from here would be a turn of how things are moving. And the global time frames of the Bank, you also see a parallel channel, and the moment is very much within that in a very volatile way. So to summarize, last week was 193, nearly 200 points move up. That's almost near to 1%, but much 0.81. That's a kind of move that happened in Nifty, but it was very, very volatile. Alright, very volatile. You'll understand that when you see the charts in the coming slides. And finally, it managed to close positive on the Nifty, but not on the Banknifty. Banknifty is closed 330 points down. That's 0.64, more than 0.5% down. So banking index also is very volatile, as volatile, or even more volatile than the Nifty. Remember, it was a correction of 11 to 11.5% has happened after a 7, and Banknifty correction much less than that, nearly 8.6% release the max correction reason. And rally from the Nifty was 72% in the last 2 years. So that's where we are. Not enough corrections have come in. But it is an 11.5% came in, and market is struggling to move further up to break that previous all-time highs, and that's where we are. So the candlestick patterns, if you see, right? So this is kind of a small body, and Banknifty also is kind of a small body, and very big wick size on both. So that's sometimes called as spinning top. But spinning top candle patterns have relevance only if it's in the top of a trend. Here that is not in the top of a trend, but that way what we can conclude from the candlestick pattern is that it is kind of consolidating within the big fall that happened 2 weeks back. Right, it is within that way it's consolidating on the medium term. So Banknifty also it's inside very much the 2 weeks before big red fall, so it's consolidating, and it is having volatility with the wick size. We can understand that, and very small body is saying that on the medium term there is some indecisiveness in the market. While looking at the daily charts for the Nifty and Banknifty, the last candle on Friday was a red one, a wide range red one, that indicates bearishness on the very short term. Same with Banknifty, even more red wide range bearish candlestick is what you see on the daily charts. But if you analyze the last 5 days, you can understand the volatility. Market moved down, made a new low, lower low, and then tried to recover with the big breakout that happened on Thursday and Friday. Naturally, some profit booking might have happened. It in fact took out the gap resistance also that was there, the gap of Nifty, but Banknifty, that gap resistance is not cleared yet fully. And Banknifty also, look at the wick size on the Monday, Tuesday, Wednesday, Thursday, Friday. So V-shape full recovery, and then another fall down. Nifty also V-shape new swing lows, and then recovery, and then a breakout. Right, so very volatile, making a new dip and then breaking out, and then facing profit booking. So resistances. So where it is right now at 24,200, that is a resistance zone with respect to the daily expansion moving averages, right? Also, that zone at the 52,000 is a major resistance. Also, candlestick wise, it is bearish candlestick, and daily candlestick for each day for the last 5 days we see, we understand the V-shaped moves and the volatility that is there in the market, right? So that's about that. And if you look at the Bollinger Bands on the daily, Nifty on the left and Banknifty on the right side, you can see that there is a small expansion that is there on the downside, although Nifty is attempting to consolidate, right, with an expansion not very much evident, but in the Banknifty that expansion on the downside is very evident. So in expansion on the downside, and also if the price is below the median of the Bollinger Bands at C20 moving average, if it is below that, it is considered to be bearish biased. So bearish biased expansion means bearish bias downside. More downside fall is what is indicative in the short-term charts of the Bollinger Bands. So that's the story of the candlesticks pattern. So basically, more than dice was super volatile, and then this happened at the end of the previous year and the beginning of the new year. That's where this big volatility came in. For reasons that's not known to me, probably prefer rolling over and taking new positions, closing and things. That could be the reasons. And that's what has happened. And a big move on the Thursday was very violent move on weekly expiry day, and then it made with the resistances. That means profit booking came in, right? The Bollinger Band story we already talked about. So that's more like we'll try to understand the momentum and the trend using the RSI indicator for momentum and the ADX indicator to understand the trend. We are doing a study on the weekly and the daily time frames both on both indices. Left side we have the medium terms, and right side we have the daily charts. So momentum indicator RSI is showing that it's sideways momentum and sideways on both time frames, sideways on both indices, and that's very much clear. Momentum is very much clear. Trend, on the other hand, is also bearish. A detailed analysis can be understood from here, but the nutshell is that both indices momentum has sideways and not yet bullish, and it's bearish with respect to the trend. Right side here, the charts of the India VIX, the fear and greed indicator, which shows that market had 2.4% spike, but still 13.5. That's low volatility regime. And the difference is that there is a 12% spike that happened. Finally, the VIX closed on a week basis, 2.5% plus from the base week. But that 12% spike is where all things went chaos. Looking at the open interest analysis on the options and the futures, we understand futures has got a sharp build-up that's negative, and open interest for the options for the January 9th for the Nifty weekly expiry and the January 30th Banknifty's monthly expiries shows that put correlations are bearish in nature, 0.76 and 0.8 on the Banknifty. They are not above the one, so they're there. So futures and options open interest is bearish, and now we will attempt to understand where the options levels are there. So 23,700 is where the highest put writing is seen, 24,500 is where the highest call writing, that's resistance. Second highest supports are seen at 24,000, and then 24,200 is the second highest call writing or resistance. Banknifty has got 50,000 and 52,000 where the highest put and call writing is seen, and 51,000 and 53 is the next level of highest put and call writing or support and resistance. That's same. Rest of things we already see. So looking at the open interest will give you an area where there is a probability of resistances and supports. It can also be understood from the charts using various techniques like moving averages, persistence, previous lows, Fibonacci, and window gaps, and all of that. Right. So basically, you see that the price is at a confluence of the 150 exponential moving average. So that's where the maximum resistance is going to be at 24,250 nearby, and then you have the 24,500 zones where you have the previous resistances, and then 24,872 is you have a major resistance, which also will break off from this parallel channel if you draw one here. So it's very crucial to take out that 25,850 nearby zones, and after that it will be rounding number 25,000. Downside suppose a new swing low is made, that's going to be the major support before then, but 200 exponential moving average will be very good support at 23,677, and then comes 23,500, 23,263, the previous swing lows, right? Then Fibonacci 61 is also crucial, but comes in at very close to 23,150. So that's how the supports are then downside on the Nifty charts. Now moving ahead to Banknifty, the support resistances can be understood similarly. We have the resistances at 51,670, 51,630, then 52,000 were 50, 20 and 100 moving average resistances are there, and 50,000 big rounding number as well. So 50,000 is going to be crucial thing to be taken out. If that is taken out, market would head up towards 52,583 and 52,810. That's resistance on the upside. Downside, previous swing lows at 50,500 nearby would be a major support, and 50,330 was the 200 exponential moving average, which is again a major support. If that is breached, then 50,000 would act as a rounding number support, and then if that is also breached, then 49,800 will be the previous swing lows, and 49,650 will be the previous swing lows after that. So that's why the supports are there from the Banknifty. Let's move ahead and see how the industrial sectors are performing. All right, sector indices. If you see Banknifty, so basically last week was kind of a recovery attempt that is seen, except for the reality and probably IT, which is close flat. We see that the metal, auto and the pharma did well, did recover. Metal also was flat, but it was up, right? This you up. IT and metal also this up. So auto and pharma really picked up, and FMCG also did. These are the three sectors that performed, but the performance is only good enough for pharma, which is where we can take the long positions as if not, but others are not. Momentum positive for a long positions if you consider the multi-time frame analysis, right? So yeah, so that's not a great thing to see that we have most of the indices of the sectoral indices are not even sideways, and they're not very close to the bullishness, except for the pharma. Pharma is only sector, right? Keep that in mind. Look at the pharma index. So here, pharma has done a correction, recovering and climbing the bull zones. Right? It's a IT index that's slipping to the sideways. Metal is also slipped to the sideways, and auto is also in the sideways, taking supports are side 40. Pharma is breaking out as we've seen, and FMCG is also taking a good correction now, trying to take support at the RSI 40 and then trying to move, but sideways as of now. Reality has taken resistance at the RSI 60s and then sliding down sideways. That's all our view. So let's see how the heavyweight stocks have performed. This critic stocks, the 7 stocks that contribute maximum to the indices. HDFC, the biggest one, slipped sideways, and then all the breakout has failed once again, is what we can see. It has failed after moving further up, giving a false impression that it may be trying to break out, but the parallel channel resistance played it, and it did retrace for the last 2-3 weeks now. So HDFC Bank is about to person the bearish momentum as bearish trend as well with respect to the ADX. You can see that. So HDFC Bank side is now Reliance, that's been the killer, and Reliance is still bearish momentum in the medium term. So it's not a great thing unless Reliance climbs back in the sideways at least. HDFC and the ICICI Bank, who has been the performer for a really long time, is slipped to the sideways now. So all big 3 players, not in great shape. ITB just leading. It also seems to be slipping the sideways, while Connect Bank always has been sideways and it remains that. IDC seems to be attempting to move up in the sideways, but as of now it's sideways, not bullish yet. So there's no major heavyweight that's supporting the market, right? It's Reliance in deep trouble. HDFC Bank, ICICI Bank, and IT stocks and Connect and ITC, they're all sideways, and that's the scenario. Well, broader markets have not had corrected and then recovered and then not ready to move down and down. It's sideways and rising up momentum. So it's still not very far from the recent highs or all-time highs that it made. So that's only good news with respect to the block. So that's what is driving the market looks like. Not the heavyweights. Heavyweights is where the trouble is, where the selling is happening, and sector indices are also in deep trouble, except for the pharma. So that's in a nutshell. Let's move on and see how the institutions have performed. DAs have been buying once again. Another 9,250 crores of buying has happened, but the Fyers have been selling. 11,000 crores of selling has happened last week. So the story continues. Story of the selling is very unfortunate that if I was continuing to sell, and derivative longs also, net longs have also moved down last week. So, alright. So institutional selling is what is bringing down the market. The money for money that's flowed in all the years is slowly going back and continue to do that. Let's try to understand the global markets, the commodities, and currencies and all that. Dealing with the currencies, spike up dollar has gained nearly 8.83% up and 109, very close to that, 108.92 with rising bullish momentum. Dollar is strengthening is not great news for emerging markets like ours. Look at where the rupee is, 85.74 with a 0.43% USD INR currency spike up. You can see that it was an ascending bit so long, and for the last 5-6 weeks it has broken out of them at all-time high. That's crazy, right? So dollar strengthening, rupee weakening like anything at 85.7 is a worry for our markets. Crude oil, it's spiked up once again, 5% plus, and at the top of the trendline channel. Any breakout from here heading towards the 80s would be trouble once again, because we are all important country, but the momentum is still sideways and hope it doesn't climb in the bull zones. On the right side you have the gold, which is in no mood for the fall down, has been consolidating, and then it's a great week for the gold, nearly 1% up, but the momentum is still sideways and rising, not bullish. So gold spikes up and continues to refuse to fall down when the market is having trouble often. So that's probably what may be happening. It's a 70% move that has happened in the previous swing lows on the gold. Gold has steadily been moving up from a long time from the COVID lows. Not from the COVID lows, but the COVID low. At the COVID time, gold did move up, then it retraced slightly, and it has been steadily moving from the COVID lows. You can say from the COVID time it has broken out, and its breakout has not stopped at it. That's what I meant. So that's about the global currencies markets. We haven't seen the markets. The global markets would mean primarily Dow Jones and Nasdaq and S&P 500, but that's because that's the mother market. And if you analyze that, you can see that there is some retracement that's happening there. Not too much. It's not far from the all-time highs, but this market is down 0.5% nearly on all the major indices. Dow Jones, Nasdaq, and S&P 500 all 0.5% or slightly more than that, and sideways falling momentum is what we see. So it had broken out following the US elections, and now there's some retracement. We'll have to see whether it is going to find supports, or is it still being following the sideways momentum or not. Right? So when the market is having problem, we may also have problems, is what we can anticipate. So that's not good news again for the bulls. Now, if you stop over the analysis and move to actionables, you have to stop this for the next one is Jubilant Foot, which is having a cup and handle breakout. Because it's already established, but still a long way to go, is what it looks like looking at the volume, momentum, and the trend, which is in bullish ons. Lowest Lab is a pharma stock, and before that, Jubilant Food Books has got franchises of this McDonald's and fried chickens and all this stuff. So it's a consumer FMCG stock, you can say, right? Consumption is a theme behind that. And next one, so FMCG is doing good, and it's a defensive stock. The market falls down, then FMCG stocks like FMCG and pharma falls. That's why we have Laurel's Bank, which is also breaking out from the panel channel. Capital handle and all this is happening, and it's a long way to move up, and movement is bullish, and trend is also bullish. Volumes are decent, just at the moving average levels. And the good risk reward of up to 1:2 can be seen in both of these, Jubilant as well as Laurel's Lab. Recent affecting stock, as I said, has been the momentum and the trend, which is in bull zones with volumes, and price action supports that. So two stock picks for the next week: Jubilant Food Books and Laurel's Lab. One from the FMCG, another one is food and confectionery. That may be the right sector for Jubilant, for Laurel's Lab from the pharma. So these are not recommendations, so this is just educational purpose charts that's presented to you. Use your own discretions and your own financial advice to get to to your decisions. I have no responsibility for your positions that you take. From my point of view, it's purely for educational purpose. Among it, there's another actionable on the FNO, and this is a ratio spread. It's a call ratio spread where we're buying an LTM call options, and then we are selling twice of that further far LTM call options, and there is some risk there. It's not completely justified, but if it falls down, we have very little loss, and immediately exit if the market shoots above the 24,800. So very good range, reasonable with respect to how the market is moving, but have tight stop losses and exit the moment the borderline of the 24,800 is breached, right? And if it is falling down and not getting into this range, then you may lose very little, very little. But if you gain, you get very rewarding. That's what call ratio spreads are all about. So that's enough on the strategies on the Nifty weekly expired. Now that we have done the analysis, have some actions, let's just try to wrap it up what we are studying. So market went very volatile last week, making a swing lows, losing low, and then attempting a recovery, and then profit booking where resistance was met with, but finally managed to close positive slightly. But Banknifty did not do that, and remember that. Also remember we had corrected 11.5% from the all-time high, and we are on the way to recover, but that's where we face resistance. And the momentum in the trend is also it's still the sideways and not sideways, and for the trend is bearish continuing. The FIs are continuing to sell, that's the main thing, and remember we had gone on, we are still in a big rally. We have corrected just 11.4%. And we're trying to decide how long to consolidate before we break out once again. That's where we are. We're trying to bucket together different factors in favor of the bulls and bears and try to understand and take a view. So India weeks remaining in the medium term. So spike up about the 15 or something. So that's slightly could be in favor of the bulls because of the fact that the less negative as of now as compared to previously. The Banknifty and the indices, both indices are facing moving average. Nifty, both of them are facing moving average resistance at less than the 20 expansion moving average. So all it's that's not in favor of the that's not in favor of the bull side. I'll take out that, and I'll put it here in favor of. Yeah, so the only thing that's the broad market indices, the mid cap and the small cap, right? And the VIX factor is not spiking too much. There's only two factors in favor of this, but the Sol seems to be in favor of the bears as of now, because look at this. Fyers continue to sell 11,000 crores selling, and they've been selling like hell for several months or continuous only selling. That's what he's saying. So that's why some using back to red mother market. And momentum also seems to be slipping down on that. Open interest is showing PCR as bearish, and futures are also short bottom negative. And weekly candlesticks are all small bodies, and you see very violent volatile wicks, and all that is negative. The bands are expanding on downside, especially in the Banknifty, bearish biased. Major sectoral indices are slipping in the sideways and struggling there. And Nifty momentum is sideways, not bullish, and trend is bearish. So heavyweight stocks are all slipping in the medium term sideways. The rises in Pearson still for several weeks now, and moving average resistances are there very close by. So the view has to be bearish. I'm going mild because probably so I cannot get to the moderate until it breaches the previous swing low. So that's why. So the view is clear that it's bearish. So you have to exercise in refracting long positions and have tight stop losses. Global cues could turn bad when the tariffs and all that of the new government comes in the US. So always keep in mind that technical analysis is only study of probabilities of resistance and supports. Just probabilities. There's no confirmation there because black swans can come in any time in the form of a war, pandemic, or recession, inflation. All this can come in any time and screw up the technical analysis. But still, for us to take the positions, technically we could get some probabilities of how likely it can face resistance and how likely it can find supports. That's all we've been discussing. But next week 23,000 and 25,000 is the range that I'm looking at. Nifty 50,000 and 53,000 is what I'm looking for the Banknifty. But as long as it's 26,000 and 54,000 in the Banknifty is taken out, we're still sideways and then moving here and there. So the rally will happen only above that. The next leg of the rally is what I mean. So always hedge your portions. A lot of strategies in the playlist where we can understand to learn how to make money or rental income while playing with hedging strategies using the options. So play it safe. Market is slightly bearish, biased. Yeah, but we had 11.5% correction already. So probably it may take its own sweet time before it breaks the new higher, breaks the new, before it turns to the new price action, which is bullish, which could turn to be bullish. I mean, as of now, it's sideways. Right, that's all I have. And subscribe, like, and comment on all this if you like the content, and share it to others if you like. I'm also active on Twitter or X, and if you want to see the daily chart analysis and all that, subscribe to that as well. That's all I have. And so thanks for watching. Happy trading, happy learning, happy investing. Bye bye.